Money makes the modern world go round. But how does the financial system actually work? How does money flow from your bank account to businesses, governments, and investment funds? Let's explore the major financial institutions that keep the global economy moving. Central banks. At the top of the system are central banks. They create money and help control the economy. Every country has one, like the Federal Reserve in the United States or the Bank of England in the UK. Their main job is to manage monetary policy. They control the money supply and set interest rates, aiming for price stability and full employment. When the economy slows down, they cut interest rates and inject money into the system. When inflation rises too high, they raise rates and pull money out, sometimes through policies like quantitative tightening. Commercial banks. Next are commercial banks. These are institutions like JP Morgan or Bank of America. They move money from savers to borrowers. They take deposits from customers and lend that money to individuals and businesses. But here's the surprising part. When banks issue loans, they actually create new money. They are lending money that didn't previously exist in the system. Pension funds. Then there are pension funds. These are among the largest financial institutions in the world, controlling over $60 trillion globally. They invest in stocks, bonds, and real estate to ensure retirees receive their payments in the future. In fact, pension funds are one of the largest sources of capital for private equity and venture capital firms. Mutual funds. Mutual funds make investing accessible to regular people. Companies like Vanguard and Fidelity pool money from thousands of investors and invest in large baskets of assets. There are two main types. Actively managed funds try to outperform the market. Passively managed funds simply track an index, like the S&P 500, usually with lower fees. Hedge funds. Hedge funds operate differently. Firms like Bridgewater or Citadel are typically open only to wealthy investors. They make bold bets on stocks, currencies, interest rates, and sometimes even political events. They often use leverage and complex financial instruments to amplify returns. And they charge high fees, usually 2% of assets under management plus 20% of profits. Investment banks. Investment banks connect companies with capital. Firms like Goldman Sachs help companies go public through IPOs, manage mergers and acquisitions, and raise billions of dollars for large corporations. They act as the bridge between businesses and investors. Private equity. Private equity firms such as Blackstone buy entire companies. They often use large amounts of debt, putting down about 20% of their own money and borrowing the rest. After restructuring and improving the company, they sell it for a profit. Insurance companies. Insurance companies play another crucial role. They collect premiums from millions of customers and spread risk across large groups. But they don't just hold that money. They invest heavily in bonds, stocks, and real estate, making them some of the largest institutional investors in the world. Finally, there's venture capital. These firms invest in startups. Most startups fail, about 90%, but the few that succeed can generate extraordinary returns. A single major success can deliver returns of 1,000 times the original investment. Final summary. The financial system is like a giant machine. Each institution plays a specific role. Together, they don't just move money, they create it, multiply it, allocate it, and sometimes even destroy it. And through this constant flow, the global economy stays alive.